Yeah. We live now. Just to warm up, waiting for everybody to get in. Give me a second. All right. What's up, good people? This is your host, Dr. Bar 2, coming to you live right now. Me and my good co-host, Terry Scipio. We just giving y'all a couple minutes to get everybody in before we start the production. Right. What's up, good people? My bad about that feedback. People. Making sure that I can see the chat so that way anytime you guys have a good question, comment, or concern, we can answer that for you. So just know we here for the people. We here to help any way we can. We're going to drop some knowledge about finance on the first and third Wednesdays with Terry Scipio, one of the best to do it. I literally got a message today when people started seeing a flyer with his face on there like, yo, he was my personal financial advisor or is my personal financial advisor for years. He set me on the right path. He helped me organize my finance, got me right. Man, I think the guy owe him a thank you card. I think he proposed to his woman after getting his money right, you know.
That's dope, man. That's great to hear.
Yes, sir.
Man, I'm excited about this joint tonight, dude.
Yeah, this is a long time coming. You know, I've been wanting to start the lives, and right now is the moment. And the crazy thing is tonight almost didn't happen on both ends.
For real.
On my end, the fire alarm went off in my complex at 9 o'clock. And you know, the fire department takes their time. They got to go through the whole building to clear it out. So it's one of those moments you're like, yo, I can't believe this is happening at this moment. I was scrambling, packing everything to try to find another location. But a few minutes before 9:30, it stopped. And I was like, oh, set it back up. Let's go.
Let's get it. Yeah, man. Same here, though. On my end, dude, I was at the house. We were getting some bad, you got those tropical storms out there. And we were getting some crazy rain at the house, and the power was flicking on and off. And I was like, come on, bro. Now, this is right around 7:30 or so. But I was just like, this is not the day that we need this to happen. But nonetheless, we here, it's happening. I'm excited. I'm ready to get going.
All right. So give me 1 second. Let me drop something in the group, in the comments to let everybody know I appreciate them for coming out, taking this time, coming out at 9:30 to learn more about finance and all of that other good things.
Definitely. I'll make sure I don't lose power here on my laptop, on my Surface here.
All right. It's 9:30, so let me go ahead and get it started. This is me, Dr. Bar 2, your host of Pill Talk Podcast. Tonight we are having our first ever episode, Dispense Written Wednesdays. My co-host, Terry Scipio, a personal finance advisor. We're here to give you guys some great information. The reason we call it Dispense is written because it's brand name only, no generic answers. We giving it good information from the professionals themselves. So I hope you guys are ready to learn something every time you tune in. So I want to start the episode off by saying number one, just for you guys coming out, just because it's the first episode, go to Pill Talk Podcast, hit the tab, go to merch, take 25% off, promo code D.A.W 25. Let me say that again, pilltalkpodcast.com, the merch tab, use promo code D.A.W 25. Dispense is written D.A.W 25 for 25% off any merchandise, and the shipping is going out immediately. So make sure you guys do that. And number two, I got to introduce my host for the night, my co-host throughout this series, Mr. Terry Scipio. How you doing today?
Man, I'm doing great, man. I'm excited to be out here for the people this evening. Appreciate everybody who gets on tonight and take in this good knowledge that we're about to give them.
Yes, sir. Yes, sir. So, all right, my man. I gave a little introduction about Dispense written, no generic answers. We coming straight from the professionals themselves. So let's make sure. I know you to introduce yourself. You already been on one of the episodes. We already did a couple lives, but just in case somebody's out here and want to know more about you, let them know who you are and why they need to listen to the advice that you've given.
So first of all, just a little bit about me real quick. Financial advisor, been in this space cumulatively about 12 years, been doing financial planning for the last 8 years, based here in Charleston, born and raised from South Cac, went to University of South Carolina, majored in finance there, married, 4 kids, driving me crazy. But all is well though, man. Just happy and excited, wanting to do more stuff like this, just getting quality information out to the people.
And that's what really matters right there, man. Getting quality information out. You know what I mean? D.A.W, you already know.
And big ups to you, man. I've watched your channel grow, and man, you've been putting out some real high quality content. So I'm glad that you thought enough of me to have me on as your co-host on this series, man. So big ups to you.
Hey, man, thank you. All right, so let's get started with it. Because I know you're ready to educate the people on the stock market and why they need to invest in it. So I'm gonna let you take the moment. Let me give you the screen so that you can start educating the people.
Right. So what I'm gonna do is I'm gonna just start by with just a couple of things that I want to say real quick. The stock market is one of those things that some people may be a little fearful of. And tonight, what I hope to do is try and help ease those fears about the potential for losing money in the stock market. The stock market will have its ups and its downs. But what I want people to take away from this instruction tonight is that although the stock market has its ebbs and its flows, or its ups and its downs, over the long haul, because what we're going to do is we're going to look at a quick case study about some of the dynamics that have taken place in the stock market going all the way back to 1970. Now, that's way before I was born. I'm an 80s baby, proud 80s baby, by the way. But just to give some people some perspective about where the stock market started in 1970. The stock market didn't start in 1970, but just looking at a monthly chart. And so we're going to unpack what technical analysis is tonight, and then just dive deeper into the chart. And what I mean by the chart, I mean a stock chart, because a lot of people, when they look at a stock chart, they see a squiggly line on a graph, and they don't know what to make of that squiggly line. And so tonight, that's what we're going to dive into. That makes sense? I couldn't hear you, man.
I said, yes, sir. Yes, sir. Let's teach them what the lines mean. Let's teach them how to read the chart and start with the basics and build on it.
All right, well, cool. That's exactly what we're gonna do. So what you're looking at right now is a stock chart of the S&P 500, and I've dialed it back all the way to 1970, January of 1970, which starts right about here. Now, for most people, they've never seen a chart in the form that I'm going to display it here in a minute, and that's in a more so what we call a candlestick view. What you're seeing right now is a line chart, and this is what most people are accustomed to seeing when they look at the news at night on TV, and they see just squiggly line, and they don't know what to make of it. And a lot of people, when they see this, they're just like, man, I don't want to have any parts of it because I just don't understand it. And so what I hope to do tonight is just give you some insight of how to understand these particular charts and what you actually want to pay attention to as the stock market makes its ebbs and its flows. So if you're following along with us tonight, what I would like you to do is take note of the values, meaning the values that you see displayed up here across the top, which are going to be labeled as open. I'm going to change this to a candlestick view chart, but you see it says O, H, L, and C across the top here. The O stands for open. The H stands for high, meaning the highest price of a particular day or month. We're looking at the monthly chart, so it'd be the highest price of that particular month, the lowest price of that month, and the closing price of that month or particular candle. So let's briefly talk about what technical analysis is. Technical analysis is basic price action, study of the price action of a particular stock or a particular index. And in this case, we're going to look at the price action of the S&P 500 going back from 1970 all the way back up to present day 2021. And what I want to start out with is to show you that one will take note of the opening on this particular day. So this is January 1970. The open, denoted by this O up here, and if I hover over this candle, says that the open price on that month was 92.06. So that was the value of the S&P 500 back then. And so write that number down, 92.06. That was the value of the S&P. And we're going to follow that all the way up to present day, just to show you that if you stay invested in the stock market, chances are you have a higher probability of winning than you do losing. I can't guarantee that your money is going to appreciate, but as you'll see in this quick case study, studies show, or the data will show, that over the long term, if you stay invested in the market, despite whatever you hear on the news or despite whatever someone else tells you, you should be able to make your own judgments about where the stock market could potentially go over the long haul. And that's what you really should be focused on, not on the short-term fluctuations of the market or particular index. That makes sense, Bartu?
Oh yeah, I'm in it. Listen, I don't pull out my book, my pen. Listen, I'm in class. Let's go.
All right, man. Well, let's get started. And throughout this, what I want people to take note of as well is the dynamics that impact the stock market and its performance. So what you'll find is this is going to be sort of a history lesson, as well as just a lesson on what makes the stock market ebb and flow. What makes the stock market go up and what makes it go down? Is it policy? Is it certain administrations? Or is it just other factors that may impact the stock market? So let's get going. So if we start here in 1970, we see that we get a small dip. So you got to ask yourself, okay, so what was happening in the 1970s to make the stock market ebb and flow? Well, one thing that was happening was we were at war in Vietnam. And then you see the market kind of takes off a little bit from this low. And if you take note of the low point here, this is June of 1970, the low at that particular point was 72.25 points on the S&P 500. And for those of you who don't know what the S&P 500 is, the S&P 500 is the index that tracks 500 of the most widely known stocks here in the United States. And well, not necessarily here in the United States, but 500 of well-known stocks. And what it will show you, what that index shows you is that when people talk about the return of the market, or if they talk about the stock market, this is the return that they're quoting. So if you listen to other online investment gurus or whatever, and they say, well, the stock market returned 18% this year, they're talking about the S&P 500. And we'll unpack that a little bit more as we go along. But we see the low here. Bartu, can you tell me what the low was here in June of 1970?
$72.25.
Was 72.25 points. Okay. And so if we go from that point, and now we're here in January 1st of 1973. So you got to ask yourself, what was happening in 1973 and 74 to make the stock market fall like it did here? Any guesses? Of course not. Nobody really tracks it like that. But I study this stuff, so I do know what was happening at that point in time. What was happening at this point in time was a shot from Richard Nixon and some of his policies, some of his economic policies that came in that he put forth, along with Watergate and a few other things that happened amongst his administration. And then so we see the low here is 62.52 points. So we had a peak here, and now it has dropped significantly, right? And then from 1974, from this bottom, what happened, and if we fast forward all the way up to November of 1980, we see that it went from a low of 62.52 points to where's the S&P in November of 1980, Bartu? What's the high?
Oh yeah, we done went up. We had 141.96 points.
That's right. So we got a significant increase from this bottom. So there's a famous quote by Warren Buffett, right? Everybody should know who Warren Buffett is. And for those of you who don't know who he is, he's one of the richest men in the world. I think one of the top three, if I'm not one or two, somewhere up in the top three, and noted as one of the greatest investors of our lifetime.
Yeah.
And he has a saying that says, when everybody is fearful, meaning when the market is dropping like this, everybody's kind of like running for the hills, right? And that's what you'll probably hear in the mass media. But what you should be doing, like he says, when everybody is fearful, he gets greedy. And if you had gotten greedy here and actually bought into the market as it was falling, you could have not recouped, but you could have benefited from this huge rise in the value of the stock market. Now, so we got this rocket off here. If I shrink this down, it looks a little bit more encouraging. And then we get this pullback here, right? So this is what I would call a pullback, or this, like if you hear some people that track the stock market, they'll say this was a pullback, or some people might just say a drop in the stock market. Well, what caused this drop in the 80s? Well, if you follow some history, you'll know that inflation was running very rampant back in the 1980s, and it peaked at about 13.5%. And that was due to some policies from not only that was during the Jimmy Carter administration, and then Ronald Reagan came in after that. And with his tax cuts and all that good stuff, this is when you saw the market kind of take off from this bottom. So if we look at this bottom right here, we had a high of 141 points. Then the stock market gave some of it back. So what was the low at this point, Bartu?
Oh yeah, 105.57 points on that one.
Mm-hmm. And so from with Reaganomics and his tax cuts and all that stuff coming into play, what we see is, again, if you had gotten greedy when everybody else was fearful, you had in 1982, when the market hit a little bit of a bottom here, you could have eaten and gotten real fat during this rise right here in the stock market, because you had a period of about, what's this, the high up here at in 1987. So that's 6 years or 5 years of nothing but parabolic growth in the S&P 500. So we went from a low value of 105.57 all the way up to, if we look at the high here in September of 1987, we're looking at a high. What's the high value there on that candle?
That's 337.89.
Exactly. So you would have doubled your money here or tripled your money here had you gotten greedy, like Warren Buffett said, when everybody else was fearful, right? And then guess what happens? Like the stock market typically does, what happened? It falls off a cliff. This is what we call Black Monday. This is when the Dow Jones Industrial Average and most other indexes sold off very heavy. The Dow Jones fell by more than 20 points in 20% rather, in one day, meaning it lost 20% of its total value in one single day. And that was in large part due to more so people panic and what we would call today algorithmic trading, when basically a lot of computers were kind of going off of some pre-programmed indicators that says, hey, if the stock hits this point, make sure you sell. And that along with investor-induced panic that's what caused a huge drop here in 1987. So we got this high, then we get this fall off of a cliff here. And what's the low point that we have here? What's the low value of this particular candle?
216.47.
Mm-hmm. So we got 216.47. And so from 1987, after Reaganomics has passed and Ronald Reagan basically reinvigorates the U.S. economy and confidence in the U.S. economy, then we get this huge rise in the stock market here, all the way up to January of 1994. So now the stock market gave back some here. The low was down here at 216.47. We fast forward from 1987 to 1994. Had you gotten greedy here, you could have reaped all these benefits all the way up to 1994. So you're talking about what's that 7-year span there of growth on the S&P 500. And so when you look at this candle, Bartu, what happens? What was the high value at that point?
Oh yeah, we was at 482 with 85.85 points.
Exactly. Now, what's the significance here from 1994 to about 1996? What starts to happen?
I think this was the .com bubble.
This is the beginning of the .com boom, right?
Boom. Okay.
So technology takes off. If this was a chart of the NASDAQ composite, you'd see an even more parabolic move than this. But just look at this monster move here on this index. So from December of 1994, we're at 462 points as the high here on the S&P 500 and we fast forward here up to 2000, right? And then boom, March 1st of 2000, what's the high here?
1,552.87 points.
So we're talking about, again, more than three times the value of where it was back here in December of 1994. So I hope you guys are taking notes here, because along the way, we've seen that the S&P rises, it falls, and then it really takes off like a rocket after a while, right? And so if we continue to follow this pattern, so we get a give back here, right? This stock market gives some of it back. Now, what happened here in 2000?
2001.
So in
That's the
2000,
bomb, the burst of the
right?
dot-com bubble.
That's when the stock market bubble burst, or the tech bubble burst, right? So you got this huge sell-off. Again, if we had gotten greedy when everybody was fearful, guess what? You would have been rewarded, right? But only to give it all back again, because
Market crash.
the market
The
crashed.
housing market crash.
And this was due to the housing market. Now, by the way, just a quick tip. This is another part of technical analysis. So whenever you see, so one thing about the lines on a stock chart is it actually forms patterns. And this right here, this pattern, if you really look at it, looks like an M pattern, right? If I was to put this in the line chart view, it's easier to see, right? You can see this M pattern right here. And this is what you call a double top pattern, because you see it tops here and it tops here, and then it sells off. So this is what you call a double top pattern, and it's typically followed by a decrease in price, whether it be on the index or individual stock. And so it's what we call a bearish pattern, because you have two types of sentiment in the stock market. You have bearish, which means that you believe the stock price is going to fall, or you have bullish sentiment, which says you believe that the stock price is actually going to go up on a particular index or stock. So from this point, from this low here in 2009, right? Let's look what happened and bring this up to present day. So we got a low here in 2009. What's the low?
Yeah, we went down to 734.52 points.
Right. And so if we had gotten greedy here, when the sky was falling and everybody was saying the United States financial system is in ruin, which it actually was, if we had gotten greedy here, you would have experienced and just left your money alone. Too many people, they try and time the market. You can't time the stock market. The stock market, hopefully what you've learned from this history lesson here is it's not about timing the market, but it's more so about time in the market. Meaning, if you can control your emotions and just block out the news and block out the media and all the bad garbage talk that's out there, and just stick to your guns and follow quality financial advice, you can be successful in the stock market, because investing in the stock market doesn't have to be some sophisticated formula. You can do something like you can take a passive approach, like buying an index fund or buying the S&P 500 ETF. ETF stands for exchange traded fund. And you could have just rode this all. So if you would have bought the S&P 500 index or ETF at this point, at this low, at 734.52 points, and just held it until present day. So all along here, this is what China trade war up in here back in 2018, right? Under the Trump administration. Then we had, everybody knows what this is right here, right? This drop off is COVID-19, right? Again, if you get greedy when everybody else is fearful, this thing is up 100%. So it fell 30%. If we go and measure out from this low point right here to the high of where the stock market currently is today, we're at about 101% return from this bottom back here in March of 2020 to where we are present day in August of 2021. That's freaking unbelievable.
Yeah. I got a couple of things to say. One, if people was paying attention, they should learn that the stock market and historical facts follow each other. You kind of can read the stock market, and if you know about what happened in history, you can kind of tell what happened to the stock market during that time in. And then the second thing is, just like most people our age who got into the stock market probably for the first time during the pandemic, who didn't have this knowledge that we about to start sharing with y'all every first and third Wednesdays. um, they would have never known that, during the crash was the time to buy in. Because I know a lot of people, they were scared. They was like, man, I'm not getting in the stock market. Everybody losing money. And for a second, I kind of thought like that for a second, but it was just like, this is the time to get all the good companies on sale and then ride the wave back up. You know what I'm
Yeah.
saying?
And that's exactly what your mindset should be. Let me point this out as well. If you go back and just Google, like, what have been the returns on the S&P 500 over the since 1970, if you just follow this exercise, right? What you'll see is there's only been 10 years that the S&P um, has had a negative return, right? And that's very impressive. So if you think about from 1970 all the way up to present day, you're talking about that's what 40, no, not 40. Yeah, that'd be 51 years, right? You got 51 years, and out of 10 out of the, I mean, 41 out of the 51 years, you've had positive returns. Think about that for a second, right? I mean, that's very impressive in the grand scheme of things. And if you're talking about having an investment strategy, what's simple that could be very simple and easy to understand. All you have to do is control your emotions and just stay invested. Don't panic. Instead of panicking when the market falls, that's when you should be buying. You should double down on your position at that point. That makes sense.
Definitely, definitely.
Now, it's another thing one other thing that I want to talk about, Bartu, and that's um, a stock that we talked about back during our first interview that you and I had.
Hold
You
on 1 second, because I want to finish something real quick that you started at the beginning. My
okay?
bad. So you started at year 71. I think the high was 92.06 points.
Okay.
So
Yep.
if you go to the high of right now, so people can see how much the stock market has grown in those 51 years or 50 years. And as you can see, the high right now, even though it's a red candle, is 4,481.26 points. So just by leaving your money in the stock market, you could see a growth that's out of this world. You know what I'm saying? Just wanted to put that out there to let y'all know that over time, no matter the ups and downs, you're always going to go up in the stock market.
Well, I technically saying we can't say always.
Oh yeah, you can't. Yeah, nothing is definite. So you can't say always, but
The probabilities are in your favor if you stay invested for the long term more often than not. But great point. I'm glad, and I don't think I wrapped that up. But yeah, to Bartu's point, if you stayed invested, you would have been rewarded handsomely. So for those people who are, let's say you have a very conservative approach to your 401k, I would ask why. Like why be so conservative in your 401k? In my opinion, and I'll just tell you, I'll speak for myself here. In my 401k allocation, I have a 100% of my allocation going to the S&P 500 because one, I understand this, and two, and this is something that you should really consider, is if you really think about your 401k, theoretically, you can't touch that money until you're 59 and a half anyway, right? So why on earth would you have, I mean, to each his own, and this is not financial advice, but I'm just saying, like, why be conservative with your allocation in an account like that where you don't have, well, theoretically, you shouldn't be able to touch the money until you're 59 and a half anyway. So why be ultra conservative? Why not take on a little bit more risk than what you would normally put on anyway? Um, but hopefully that makes sense to everybody.
Yes, sir. Yes, sir.
Do we have any questions in there, Bartu?
Nah, they're just telling us we top five now and giving us the fire symbol. So they're enjoying it. They're enjoying the info, the knowledge. So you know what I'm saying? That's the only thing we can ask for at the moment.
Definitely, man. Well, let me go back to one thing that we were discussing in our first interview way back when, right? I think when was our first interview, Bartu? When did that take place?
I think I still living in South Carolina. So it had to be like 2000. I just became a pharmacist, probably 2015, 16.
Well, I'm talking about when was our first podcast interview for you and I?
Oh man, you one of my first guests. I think you like episode 6, episode 7. So that had to be December.
Okay, so December of last year, right? December of 2020 is back here somewhere, right? And we were looking at, I remember the price of Boeing at the time being $100 or so. So it had to be somewhere down here, maybe around 140 or something like that. Because I remember looking at one of your other videos and saying that Boeing was up $100 since the last time we spoke. So I think Boeing was trading down here at probably around $140 per share, right? And I just want to enlighten people for a minute. If you if you if you think about, because a lot of people may say, oh, $200, $219 for one share is very expensive, right? And I would argue and I would challenge that thinking to say, well, you'd be quick to put $219 in a savings account. And how much money will that person particularly earn on that $219 sitting in that savings account? Take a wild guess. What do you think?
It's negative because they losing money with inflation.
You'd be right, my friend. So I want to put things in perspective for people because one thing people will say is, "Oh, that's expensive." Well, expensive is relative because if I told you that you can take, even if you only bought one share, right? You buy one share of a quality, high quality company like Boeing, a blue chip company, and you bought it here at back here in November for $140 per share, and within almost a year's time, you're looking at an appreciation on that stock. Boeing closed today at 219, right? So 140 to 219, that's what 140 to 219, that's 70, that's 70,
Let's just
70,
say 70 something dollars. We're not gonna.
yes, $79, somewhere up in there, right? 140
Mhm.
to 219. Yeah, 140, 219. That'd be 79 dollars in less than a year that your money has grown. Far more money than you would have earned on your $219 sitting at the bank, right? Or your $140 sitting at the bank if you had bought it that one share back here. So you're talking about, let's just put that in percentage terms right quick. So you bought it for 140 and it's up $79 divided by,
That's a 50% return.
easy, right? So
So,
go ahead.
I don't know. You can finish your statement.
No, that, I mean, like you said, that's more than a 50% return. Where can you go and get a 50% return on your money? Not very many places, right?
Mhm.
So, check your thinking if you're out there and you're thinking something is expensive. Expensive is very relative.
All right.
And you
I
just
got
got,
a question for you.
Go ahead.
So we went through the history. We showed people how history and things that happen in time can affect the stock market. And we just showed them how investing in the stock market can raise can can help them gain money on investments. So I do have a question here from Michael. How
Okay.
do you choose which companies to invest your stocks to invest stocks in? So what do you look at to choose a company to invest in?
Great question. So it's a couple things I would say before I would just say give a give a blanket answer. First thing you got to ask yourself is, are you someone that's trying to trade, or are you someone that is trying to invest? Because the two schools of thought are very different. If you think about, if you're that person that's just trying to make a quick buck and you're just trying to flip your money, then you're a trader. And the trader is someone who either is going to be in something of, for very short nature. Either they may trade at the beginning of the day, the first 15 minutes of the market, or they may, be trying to be out of the market they may be a day trader and not stay in a position longer than 24 hours. So in those scenarios, it's like dating, right? If you're dating somebody, you're not trying to kiss her in the mouth on the first date, right? Otherwise, she gonna look at you sideways. So if you're a trader, you look for different things. So for a trader, they may be looking at a trend and maybe just trying to catch hold of that trend. Maybe that trend is they see the volume spiking on that particular stock and it has a bunch of momentum behind it for the day. So they're just trying to ride the wave and make that quick buck on that particular stock. And on the flip side, an investor, they'll look at a company like Boeing back here and say, well, Boeing is even here at 219. They'll say, well, Boeing was pre-pandemic. It was up here. Y'all see that I got, these are called trend lines, these blue lines. It was really as high as 440 something dollars back here prior to the pandemic, right? So at $219, this thing is still at a 50% discount. So this would be a great investment. And that's how you have to look at these things. If you have, if you take some time and enhance your knowledge on stuff or better yourself, you'll be able to interpret these charts in a better way and be able to make an educated decision. So you have to ask yourself, are you an investor or are you a trader? Are you looking for a quick buck or are you looking for long-term investments, high quality investments? So to answer his question, I would evaluate the stock chart, use my technical analysis to evaluate this chart and say, okay, is this a high quality stock? And is there value still left on the table here that I could still reap from investing my money today and maybe over the next couple of years, wait till Boeing climbs back here to $440 and above, and then take my money and run at that point. So
Right.
it's a culmination of things in addition to some of the fundamentals of the company. The fundamentals being like the financials. Are they meeting their earnings expectations? Is the company stable? Are they showing quarter over quarter growth? And you know, a number of other factors that could go in there from the fundamental side of things.
So he came back and answered your question, which is like he's looking to be an investor, not a trader. So let me put my little 2 cents in here real quick. Because we're looking at Boeing Company and this chart is already up. So I just say this. So for me, if I was looking to invest in this right here, this company came across my radar, I would look at the chart like how he got it pulled out for I think we got 3 years, 4 years down at the bottom.
Well, this is the daily chart, so you're looking at 1 day candles here.
But I'm just
Um,
looking at the bottom, like years. You got it back to 2018.
right.
So I would look at this chart. First, I would go Google and do my research on see who is Boeing. And I look at them and be like, okay, they make airplanes, right? Oh no, is it the
Yeah.
jets?
No, Boeing, they have several different divisions. So Boeing They have a military division, they have the aviation division, and engine division. It's a number of different
Different divisions.
yeah
All right.
pots they have their hands in.
So I would look at the chart. I'll pull it back at least 3 to 5 years and see where the company was going, see the trajectory. And I see this from this view right here. I'm like, okay, I see it's at $445 pre-pandemic. And then, like we just talked about a second ago, when everybody's fearful, you be greedy. So when the pandemic hit, this long red line that goes straight down, I'd be like, all right, right now, I would just do some basic thinking. During the pandemic, no one could travel. So obviously they couldn't make new planes. So
Right.
obviously the market had to go down for them. So I'd be like, all right, the pandemic can't last forever. So what I need to do right now, let me catch the stock at this discounted price at about 100, under 130 something dollars. Um, and be like, oh yeah, 104. All
Mhm.
right, boom. Let me catch it at 104 because I know when the pandemic is over, this is about to skyrocket up because one thing that airlines has to do, they have to get new planes every so often.
Right.
So it's like all those planes that went down during the pandemic that wasn't doing nothing that was already old, they're gonna rust out. They got to get rid of those. Boeing's about to come in and be like, listen, we got all the new equipment. Come on and buy from us. We back on the market.
And right, and Boeing is not just a
Boom.
domestic company; it's an international country. I mean, not country, but company. So they sell planes all across the globe, right? And eventually, like you said, after the pandemic, people aren't just going to stop flying, right? They're going to eventually get back on planes, and because planes have been sitting for quite some time, companies will have to make new orders for new planes in some instances where it's needed. So you can imagine that future growth for Boeing could be pretty positive. So that would translate into, as you can see here, positive earnings looking forward based on the future orders that will be coming in from other carriers around the world.
And then, like we spoke about a minute ago, when we looked at the S&P 500 as a whole after the pandemic to where we at now, it went up 100%.
Right.
So if you catch some of these good value stocks or good value companies at their low, you could be up a whole 100% on them, or you could be up in general. You know what I'm saying?
Right.
So just finding those companies. But I think what you're really asking is how do we select the company that we want to invest in? We're going to break that down and go through those things, those steps, and what we look for in a company and why we would choose a company throughout our series. So make sure you stay tuned every first and third Wednesdays with Terry Scipio as he break down the market.
Definitely, man. Do we have any other questions in there, Bartu?
Right now, no, but I got a question. I know they're probably going to ask it soon. They probably going to hit me. They hit me up directly. I don't think people like really talking in public at the moment. But going through different companies and looking at their charts, and then like you said a second ago, looking at their financials. Are you going to be able to take the time throughout the weeks and sit down and break it down their financials? What should you look at, like the EPA, the
Yeah,
the expenses and all that? And are you also going to sit down and choose different companies to go through? And for anyone out there, if y'all want a particular company that you want us to look at, I know the hot ones right now are like Apple, Microsoft, Google. Make sure y'all leave that in the chat so that way that me and Terry can talk about it and we can put that inside the program to make sure that we go through at least one or two different companies to show you what to look at, what to look for, and if they are a good stock to buy into.
definitely, man. And it's not as hard as one might think. You just got to know what you're looking for, And once you know what you're looking for, just like anything else, when you're doing any type of research, once you know what you're looking for, you go out, you seek it, you find it, then you evaluate it on your own based on other metrics. And if everything checks out, that should be a company that you would take pretty seriously.
Definitely. So what else you got for them tonight? Because we went through a few different things. This is just the appetizer to get y'all right, to let y'all know that we got the information. We know a lot. And want y'all keep coming back because we got so much more to share. But what else you got for them?
I got one last thing that I want to do here. I'm gonna stop the share for a second as I log back into uh, my system over here.
Yeah, don't show them your passwords now.
But I want to show people there's something called the sequence of returns. And I just want to show people really quick how, if you don't necessarily have a plan, how the sequence or how the returns on your money come in, how it can affect your portfolio. So, what I'm saying here is one should have an approach to their financial plan that will help them mitigate the risk of the stock market and its volatility. Meaning, volatility is a fancy way of saying up and down. So, what I'm going to do is I'm going to just look at, okay, what would happen to somebody who had $1 million and they experienced a certain return during a certain period of time. So we're looking at a 5-year period of time here and a 5-year period of time here. Both accounts start with $1 million, right? But the difference is you're going to see in this 5-year period, you got positive returns here. And then in this 5-year period, you got 2 years where you have you got double-digit returns. But in this sequence of returns, you have almost double-digit losses for 3 consecutive years. Okay. So let's just see how this plays out. And if you don't have a financial plan that's going to help you mitigate these types of risk, because as you age, you're not going to be as aggressive as you once were when you were younger, right? And so therefore your allocations with your money and how you spread it around is going to be a lot different as you age. So if we look at this and just real quick, starting with $1 million, if this person right here, let's say we had 2 people that retired, person A here in this sequence of returns, their account ends up with an account value of $2.6 million, assuming they took out $80,000 on an annual basis to possibly try and retire as a portion of their retirement income, right? And so now let's just fast forward here and look at this person here, person B, who had the same $1 million, right? Had the same amount of cash flow on an annual basis, same 80,000 here, 80,000 here for person A and 80,000 for person B, $1 million account value to start with in year 1 of their retirement. But we can see here the first 3 years, this person experiences 3 years of consecutive losses. How does that impact the portfolio? And I just got to ask a rhetorical question. Would it make sense to be taking money out of a bleeding portfolio or a bleeding asset? Does it make sense?
Nah. They need to be trying to find a way to put money in it or stop the loss.
Right. You got to stop the bleeding to a certain degree. But for most people, their retirement plan is basically one-legged, meaning everything that they have is tied to the performance of the stock market. And therefore, their sole source of retirement income is predicated upon the performance of the stock market having great outcomes. But what if you were that person that was so unfortunate to have the first 3 years of your retirement experience almost negative double-digit returns, in your first 3 years of retirement. This person's retirement scenario is going to be drastically different 5 years down the road. This person here, while person A is going to be thriving, right? This person is contemplating going, ain't no contemplating about it. This person right here going back to work at 70. You know what I'm saying? So far different outcomes. And you're talking about the same person, that the same two people that both had $1 million, but their sequence of returns played out a little bit different. Does that make sense?
Oh yeah, definitely. But I do have another question for you. Um, Going back to investments though.
Okay.
What about REIT? What about REIT investments? Are they a good buy for the long-term investments? So let me break down what a REIT is. REIT, real estate investment trust.
Mhm.
So I'm gonna pass it back to Terry now to let you know exactly a little more about that, since he can actually pull it up and give you guys some more information on it.
So a REIT is I'm a big proponent of real estate. I like real estate as an investment. I like it as a passive income investment, um, to help generate some passive income in retirement, as a strategy. But if you're that person that says, I don't want to own physical real estate, then having some portion of your money in a real estate investment trust or REIT is a good idea. What percentage, that all depends on the individual. If you're somebody that's very bullish on real estate, and you might want to have a higher allocation than somebody who's not so big on real estate as an investment. But generally speaking, real estate is always one of the best performing asset classes, meaning if you look at, say, stocks, bonds, international, when I say an asset class, that's what I'm talking about. You got different classification of different assets, whether it be bond, US stocks, foreign stocks, bonds, investment grade bonds, whatever. When you look at all of the different asset classes matched up against one another, real estate is always in the top, top three, top five performing asset classes across the board year after year. So with just that basic understanding of the performance of real estate over time, it would make sense to have some portion of your money in a real estate investment trust or in some type of real estate allocation.
I say this right here. One thing that I know a little bit about it, they pay dividends monthly, like they have to. So if you find a great REIT and you start investing into that, dollar cost averaging, so which is investing a certain amount of money on a regular basis, and you do that for over time and getting the dividends paid back to you every month, you can definitely see a good growth in your investment fund.
Definitely, definitely.
Do you know a REIT offhand that you could pull up on there so you can show them? Or
Um, yeah, Vanguard has a good real estate investment trust. Um, what's another one? Simon Property.
I actually was invested into a REIT at one point that I
So
was doing.
so this is a big one. This is a big conglomerate right here. Simon Property Group owns a lot of commercial real estate, a lot of the malls that we shop in. So this is more so a stock rather than a REIT, but this is a conglomerate that invests in a lot in real estate. So you can see the trajectory of this. I mean, most stocks had, this fall, this plunge right here, back here in 2020, but you can see this rebound in Simon Property Group here has been very strong. And they're about at pre-pandemic levels from where they were, right? Because This is the high from February of 2020 before the market actually collapsed. And if we see, now this has been in sort of a downtrend here. Well, no, it had a period of consolidation right here where it kind of moved sideways. You see that?
Yeah.
But you can see that it's almost back up to its pre-pandemic level here at 148. This was the high before the pandemic right here in February of 2020 at 143. Stock is at 128, right? So it's
Yeah.
not a whole lot of meat left on this bone from a value perspective, but for most people, for some analysts, this might be an undervalued company because what they may see as the future of Simon Property Group growth in terms when you look at their numbers and you compare their earnings and future growth perspective.
Yeah. Dope.
Any other questions?
Now, I think for tonight, we answered all the questions for the night, but we definitely going to come back with some more good information and break it down, and have a little more different charts to show people. But for the night, man, I think we knocked everybody questions out. They're saying there's some good information that we giving them. They already subscribing. They're ready for every first and third Wednesdays to
Good
get this
stuff, man.
finance.
Good stuff, man. We're gonna be on here talking about personal finance every first and third Wednesday. We got two more series where we're gonna discuss the stock market, and we can cover as many different charts as you like. We can take a look at them and analyze them and talk about different patterns that actually form in the stock market. We'll put together if you guys really have some questions before or have a particular stock or company that you want us to look at, please put that in the comments below, and we'll take time to analyze it and give our take on it, and let you know what we think, and if there's some value to be had in a particular stock.
Yes, sir. Yes, sir. So if you're liking what you see here tonight, before I wrap it up, anything else you want to say?
No, I'm good, man. I'm good.
If you're liking what you see here tonight, please go ahead and subscribe to our YouTube, also our Instagram, Facebook, all of that good stuff. You can find Terry Scipio on Instagram at Terry_Scipio. You can find me at Pill Talk Podcast on Instagram, YouTube, Anchor, all that other good stuff. So make sure you subscribe. Make sure you ask questions. Get engaged. We want to hear more because we want to deliver more and make sure that you get everything that you can out of these sessions. So we will be here every first and third Wednesday, giving you guys personal finance information, going over stock market, anything and everything that you guys need.
Hey, and if they want to connect from this podcast, they can go to pilltalk.terryscipio.com, and it'll bring you to this page. And you can look here, you can click here, and we can schedule some time to have a chat. This beautiful little girl right here is my baby girl. Looking like her daddy.
Family, man. Gotta love it.
Definitely, man. But definitely connect with us on all social media. Go check out, you can go to scipiofinancial.com. That's my website. Still being revamped a little bit, but got some good stuff on there. And on IG, like Bartu already mentioned. And we look forward to connecting with y'all.
Can you show them also they can jump on pilltalkpodcast.com and they can get in there to anyone that wants to get merchandise, the Pill Talk Podcast merchandise. You can go on there, get you some merchandise, 25% off with promo code D.A.W. 25 for 25% off. And I got a back to school sale just in case you want to get your kids something. But yeah, great information. Come on out, connect with us, and we here for you every first and third Wednesdays with finances with Terry Scipio, and every second and fourth Wednesdays I will have medical providers and entrepreneurs coming on talking with you guys. And I think next week I got a good friend of mine. He rents slingshots out of Atlanta. His name is Think.Keen on Instagram. So make sure you tune in next week. We're going to be talking about slingshots. So
All right.
we out here.
Y'all gonna be getting it.
Yes, sir.
Good, man. Well, thanks for I was enjoyed being a co-host for this evening, and look forward to getting on, man, the rest of the month here.
Yes, sir. You have to send it back to me as the host so I can.
All right, let me do that right quick. All right.
All right, guys. Thank you all for coming out. Hold on, did you do it? All right, no, got it.
All right.
Have a